When your blue chip anchor drops 8% in a single day, it is time to check if the floor is still solid. Genting Singapore just saw a 55% profit collapse, and today we are auditing whether that 5.8% yield is a sanctuary or a trap. By the end of this, you will know exactly if your retirement income floor is taking on water. I have been watching this one for a while. The 55% number made me run the data twice. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. These are the numbers setting the context for every verdict you will hear today. The STI level is sitting at 4,946, and we are monitoring key support levels closely as Genting's slide drags on the index. The 6-month T-bill latest auction cutoff is at 1.40%, while the 3-month SORA compounded rate is at 1.08%. Meanwhile, the IJET S-REIT index is tracking around 1,024.2 as we look toward the June futures. Starting the audit with Genting Singapore, the forensic verdict is clear. The balance sheet is a fortress, but the earnings engine is taking on water. Our Q1 net profit came in at 65.2 million Singapore dollars, a massive 55% drop year-on-year. Free cash flow also halved to 211 million Singapore dollars, while the yield of 5.8% technically passes our 4.7% hurdle, and the $3 billion cash pile is a genuine fortress. The momentum is moving in the wrong direction. Breaking this down into our forensic layers, that 55% profit drop triggered a sharp 7.97% share price drop in one day. When we benchmark this, we see 3 consecutive annual profit declines even before this Q1 collapse. Looking at peer context, Marina Bay Sands is reporting record margins, which suggests Genting is either losing market share or facing structural cost issues at Resorts World Sentosa. If margins compress another 10% in Q2, free cash flow could fall below 180 million Singapore dollars. For a 65-year-old retiree in Bedok, a 10% dividend cut removes about $400 a year from discretionary spending. That is the difference between premium choices and house brand logic. This is a tale of two balance sheets. On one hand, you have a 3.2 billion Singapore dollar cash position that makes the total debt look like pocket change, a genuine sanctuary of liquidity. On the other hand, a fortress does not help you if the people inside have stopped making money. A 55% collapse in profit and 3 years of decline cannot be ignored. If this is not arrested soon, that yield starts looking like a trap rather than a floor. The earnings engine is structurally slowing, and the cash pile is not a substitute for earnings. Moving to NTT Data Center REIT, we see a much healthier picture. This is a clean IPO beat in a high-rate environment, proving the data center floor is real. The H2 distribution per unit of $0.0387 beat forecast by 2.4%. With gearing at 32.5% and 70% of the debt on fixed rates, this balance sheet is built for the long hold with 0 maturities for the next 3 years. Looking at the visual breakdown, NTT Data Center REIT's gearing of 32.5% clears our 35% ceiling with plenty of headroom. Compared to regional peers who are sitting at 35 to 40% gearing, this REIT is much better insulated. Those peers are facing distribution pressure as floating rate debt reprices, while NTT Data Center REIT's treasury positioning provides stability through at least 27. For a 55-year-old PMET in Jurong using SRS funds, this is a sanctuary signal, though you must factor in a small currency haircut for the US dollar denomination. Turning to United Hampshire US REIT, we hit a Zone 4 caution. While the organic growth is real, it is sitting on a cracked foundation. Net property income rose 12.7% to $13.2 million with no sponsor top-ups, which looks great on the surface. However, the gearing is at 38.6%. That is a hard gate failure against our 35% ceiling, and it is trending even higher toward 39%. This gate failure matters because as US rates stay elevated above 4%, refinancing costs will rise. A 10% rise in financing costs on a 39% geared balance sheet will directly erode the very organic growth that makes this REIT look attractive. For a 45-year-old HDB owner in Toa Payoh, this asset disqualifies itself on the gearing gate alone. You cannot let operational growth mask a structural breach in leverage. Looking at the analyst chatter, most institutional houses are neutral on Genting, citing the $0.85 level as a valuation floor because of the cash. But our forensic filter is different. We do not buy cash piles. We buy the cash flow they generate. 3 consecutive annual declines fail our earnings trajectory test. Until profit stabilizes, that 85-cent mark is a theoretical ceiling, not a floor. In our watch list and yield spread, GENTING'S yield is 5.8% against the 1.4% T-bill, giving a risk premium of 4.34%. My minimum yield hurdle remains at 4.7%, based on a 3.2% stress test floor plus a 150 basis point risk premium. I do not drop my standards just because T-bills dip temporarily. We audit for the storm, not just the sunny day. The window is already open. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. By the time this analysis reaches free subscribers, the entry window has often already opened and closed. Iggy's elite investors do not just get these reports early, they get 0-day forensic breakdowns and the full red zone watch list when the numbers still matter. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you can stop being the exit liquidity and start being the analyst. The bottom line for today starts with Genting Singapore. The cash is real, but 4 consecutive deteriorations make this a loud watchlist trigger. Watch the CAPEX guidance for Resorts World Sentosa 2.0. NTT Data Center REIT is a strategic neutral with high-quality metrics, while United Hampshire US REIT is a hard gate failure on gearing. Finally, Keppel closed up over 1% today, but the balance sheet questions remain. I will have the full picture for you on that tomorrow. Do not confuse a strong balance sheet with a healthy business. The gap between a $3.2 billion cash pile and a 55% profit drop is exactly where heartland investors get trapped. Ground your expectations in the yield spread because if the risk premium does not justify the volatility, the T-bill remains your only true sanctuary. This cycle proves that even fortress balance sheets cannot hide a slowing engine forever. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. If you are tired of being the last to know when a blue chip anchor starts to drag, join our community of Iggy's elite investors. We have a 7-day embargo on these forensic deep dives for a reason, so our members can move before the market prices everything in. Click the link below to secure your spot. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.